Welcome to the GSMC Business News Podcast, the show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. If you're looking for a podcast to keep you informed and ahead of the game in business, the GSMC Business News Podcast has you covered.
Hello, and welcome to the GSMC Business News Podcast, brought to you by the GSMC Podcast Network. I'm your host, Paula DuPont, and today we have a number of issues to discuss. First is we're going to be talking about the state of our economy, looking at it from a couple different angles. One is that this period of time has been more or less officially declared a recession, and what that means, while at the same time, Wall Street, in terms of stocks, has been pretty much coming back to pre-pandemic levels, which were pretty high to begin with. So a good recovery there, and we're going to get a little more into that. We're also going to be talking about the new rules for the Paycheck Protection Program. And these rules should benefit the small businesses who've taken them and perhaps increase their chances of having the loans forgiven. We're also going to talk about delivery apps for restaurants and what the impact has been on them during this pandemic when they've had to rely on them so heavily. Also on the effects of summer camps being closed on small towns, what that's doing to their business. And finally, we're going to talk about Purple Mattresses and its unique advertising approach, which has actually led them to have surging sales during the pandemic, better than they've ever had. So all these topics and more in just a moment. These past several weeks, there's been a lot of name calling, at least when it comes to defining what this impact to the economy is of the coronavirus. And what that looks like, you've heard the terms economic downturn, of contraction. Some people have even said this could be the start of a depression. That's not maybe as commonly discussed. But now the National Bureau of Economic Research out of Washington yesterday declared this period of time as a recession and that it began in February. So that might just be renaming something we've already known was there and it's ugly and all that a recession implies. But the fact that they have just finally called it that, defined it that, I guess better explains the kinds of impacts and even some of the expectations that we have around recovery. So when this recession began, as I said, was declared to be February, and that marked the end of a 128-month expansion. That was the longest running since 1854. I mean, think about it. That's well over 100 years. So some would say we were due. And of course, the Depression and a recession back in around 2007 to 2009, would also show that we were balancing this bigger picture of expansion. But the fact that we had 128 months worth of expansion was pretty significant, and it probably positioned us maybe a little better to bounce back, or at least we can hope. This despite calling it the recession, the Dow Jones Industrial Average rose 461 points on Monday, and that's up 1.7% and just 6.7% shy of its February highs. So it's kind of a contradiction in a sense, and we're going to talk about that a little more in a story later in this podcast. But basically, by defining it as a recession, although it doesn't change the current circumstances, it can, in a sense, stir more of the need for more congressional aid, for more economic relief. And, so far we know Congress has provided $3.3 trillion in emergency spending and tax breaks to support the economy. But, there are already different groups that are lobbying for more aid. And in effect, at the same time, that we're looking to get more aid, we also see a ballooning budget deficit. And I think we all know that that's looming out there and it's growing. We're not sure how we're going to deal with that. But right now we're trying to deal with the matter at hand and what's going on currently with the economy. Some policymakers are predicting that consumer and business spending will bounce back quickly once the social distancing measures are lifted. And others have expressed concern about lasting economic damage. So another expert, economic expert, has said that while the recession will likely be much shorter than the previous one in 2007 to 2009, the aftermath could be similarly long and slow given the severity of the shock. So the fact of how quickly this came upon us and the demise that it's had, could make this last longer. And there's different theories on that, but where in the beginning, I think there were more that were thinking we would quickly recover and start recovering more rapidly, or at a more rapid rate beginning in June, to start the second half of the year recovery. And now some are saying, well, it might take a little bit longer than that. In fact, the Congressional Budget Office said recently that the U.S. economy could take the better part of a decade to fully recover. Gross domestic product will likely be 5.6% smaller in the fourth quarter than a year earlier, despite the expected pickup in economic activity that we may see in the next few months. The Congressional Budget Office also said that the budget deficit is likely to hit $3.7 trillion by September 30th this year. So again, something that we're going to have to face eventually. There are, however, some signs that the economy might have already hit the bottom and is on its way back. Employers added 2.5 million jobs last month, which is, of course, a promising sign, and that is the most in a single month since 1948. So, and also the unemployment rate fell to 13.3% in May from April's 14.7% unemployment rate. So there is a good sign right there. Overall, though, the jobless rate is one of the highest it's been since the Great Depression, with employment overall being down about 20 million jobs. So still, there's good news, there's bad news with it, but the important thing is I think we are seeing some improvement in some areas. And as I said, the stock market doesn't seem to plummet every time we get one of these bad news reports. In fact, some days when dismal reports are released, the stock market seems to go the other way. So it seems we have that going for us. Still, the depth and duration of this recession depends on a lot of things. One of them, of course, the big one being the trajectory of the virus, if there's going to be future outbreaks, and what that impact would be on the economy and shutdowns. And of course, if there is more aid from Congress. So we are going to talk about a little bit more about some of those topics as we move on. We're going to take a break, and when we come back, we're going to talk about the stock markets.
Are you looking for a podcast that gives you all of the latest news from the world of finance? Then check out the GSMC Financial News Podcast. We'll delve into the ups and downs of the stock market, changes in the economy, and news from the world of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we'll cover it on the GSMC Financial News Podcast.
As I said in the last segment, the stock market seems to be going on its own path, not so closely related to news that comes out about the economy and about the coronavirus. It's hard to make heads or tails of it, but the bottom line is that as of Monday, June 8th, the S&P had climbed back to where it was about a year ago, which was pretty good. And that is an encouraging sign, of course. And, it doesn't necessarily indicate how we're doing in other segments of the economy. But with the stock market, it's been doing pretty well. This last day of trading, or June 8th, effectively erased one of the worst periods in recent American history in terms of the financial record. Stocks rose 1.2% on the same day that economists said the United States fell into a recession. So that's what I was mentioning before. So even though we have the economies opening up in different cities in the country, different states, and you have it, of course, throughout the world, the overall outlook for the past 3 months has been, obviously pretty dismal. You have tens of millions of people out of work. You have corporate earnings that have plummeted. Industries such as tourism, retail, and entertainment have been hit extremely hard. And I've heard statistics about restaurants, and maybe half of them or so are predicted that they won't come back after the lockdown is lifted. So I see plenty of that actually in my area of long running operations that have shut down already. So they didn't even get to make it to opening up. And, it's unfortunate. So we see that happening, but at the same time, getting back to the stock market, it doesn't seem to reflect that. Although initially, in the beginning of the lockdown, the market dropped 34%. Since that time, when there have been different major announcements, like when the Commerce Department announced on April 29th that the economy shrank at a nearly 5% annual rate, stocks rose 2.7%. And then a month ago, when the Bureau of Labor Statistics published the worst possible employment report that we've had in a long time, decades, where 20 million jobs were eliminated, the stock market rose 1.7%. So you might ask, why is the market behaving this way? What's the explanation? And I'm drawing, by the way, from an article that was in the New York Times on June 9th. But one of the answers that it offers as to why the market is responding this way is largely because of the federal government help. And that would mean not only the announcement that it would provide a backstop by using its emergency lending powers to buy assets from municipal to corporate debt with newly printed money, but also the government-backed bonds through its unlimited buying campaign. And it credits some of those things to why the market has responded this way. Since March 23rd, the Dow Jones Industrial Average has soared 48%. The NASDAQ Composite Index, which is heavily weighted toward technology, is up 45%. And it actually closed at a record high on June 8th. So it's felt too that some of the big tech firms, tech-based firms like Amazon and Microsoft, were actually very well positioned for the pandemic lockdown because of the products, obviously, that they have and services that they provide. Also, the S&P 500 is up nearly 45%. So some significant positive indicators, at least on from the stock market point of view. Since the Fed began taking steps in early March, it has added roughly $2.9 trillion to the economy and believed to have gone into the financial markets. So pretty significant amount there that would give some credence to that aid being a direct influence on how the market's been performing. But looking at individual players in the marketplace, the biggest winners in the stock market appear to be those who were suffering beforehand or at the beginning. They were most impacted by the shutdowns. And many investors have seen that as an opportunity to gobble up their stock while it's low and then bring it back up. So that's what's been happening. We've also seen where the energy or the oil market had really taken a real dive earlier on, largely because of being able to move oil and not having the demand, and it was backing up supply and, of course, driving the prices down lower. The stock price of the Apache Corporation, which is an oil driller, quadrupled. Stock in the oil field services giant Halliburton has tripled. So that's begun to come back because, due to more investment. Naturally, there are those that feel we shouldn't get too excited about the increase in the stock market. Even though there's positive signs overall and more states are opening up to business, the idea that we're going to have a V-shaped recovery curve, and the fact that, and the belief too, that there will be a vaccine by the end of the year or early next year, which some doubt will happen, that those things may not necessarily happen, and there's some pretty good indications that it won't. We haven't really heard much recently about new developments in the vaccines. There was a while there where we were having new developments every day by a different vaccine manufacturer going into human trials and testing and feverishly reporting their results to suggest that, we're going to have something by the end of the year. So we don't know. Then, there's the whole idea of, could we have a second wave of the virus? And there are many that are predicting that will happen in the fall. So a lot of variables there that we have to factor in terms of how the economy is going to hold up and continue to recover. Naturally, it's a great indicator to have the stock market up. because hopefully that'll start to balance out. And hopefully, too, with more and more states opening up and consumers being able to spend their money, we'll see an increase in consumer spending and hopefully get the economy back up in as close to a V curve as we can see it. Maybe it'll be more a U curve, but either way, hopefully soon we can do our part. So we are going to take another break, and when we come back, we're going to talk about the latest developments regarding the PPP program.
Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings-on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand.
As you know, the federal government created a program called the Payroll Protection Program. And it had put this out actually in two different waves back in March and April. And when the program was initiated, there were a lot of criticisms about how the program was administered, who was able to qualify for it, the duration of it, if you would have to pay it back or not, a lot of different issues. Well, recently, as in last Friday, President Trump signed the legislation known as the Paycheck Protection Flexibility Act. And what that did was basically relaxed some of the rules and expanded some of the components of the program so that small businesses who took the loans have a little more time to use the money, to a little more flexibility in how they use the money, and also a little more flexibility in the criteria of when and if they have to pay it back. So this was really a welcome development for many small owners who were struggling with paying the rent, paying for supplies, but having to spend 75% of the loan for employees in order to qualify for it as a grant rather than a loan they'd have to pay back. So this program, under the new law that was signed last week, basically businesses may spend less money on payroll and still qualify for the program's major component, which is a pledge by the government that if used properly, the loans are forgiven and become grants, essentially. Under the new rules, borrowers now may use the money over a 24-week period rather than the 8-week period that was set up in the first legislative act. In addition, loans can be forgiven even if employers don't bring back the same number of employees. And business owners now must use 60% of the money on payroll instead of 75%. So a little more leeway where that's concerned. Business owners also now have more time to bring back workers. That was another big point of contention because, of course, the rules about opening businesses have varied by different states and sometimes people weren't able to bring back workers right away. The repayment period for the PPP loans is now 5 years, up from 2 years. The deadline to apply for a PPP loan remains June 30th. So there still is money available, and people or small businesses can still apply up until June 30th with this program. The new legislation also addresses the issue of rehiring and what happens if you can't hire the same employees back, if you can't hire, if employees don't want to come back, or if the situation's changed and you don't need as many employees. So it's not a situation where under the old legislation, if you don't meet those certain numbers and don't bring back the same people, you would have to pay back the loan. Well, in this case, as a business person, if you have asked an employee to come back and you have offered a good faith written offer of employment and it's rejected, you still may be able to have the loan converted into a grant. If you fired someone for cause, that also would qualify. And then if you found out that you've been unable to hire a former employee or similarly qualified one, and can't restore business operations to their February 15th levels because of COVID-19, you still could qualify for the grant. The law gives you more time to apply for loan forgiveness, and that deadline has moved from June to December 31st. So people have more than 6 months, to repay the loan if, in fact, they have to do that. Now, the new legislation doesn't provide the clarity that some have been looking for in terms of business expenses, about what's deductible and what isn't. Right now, it's still not clear if loan money spent on business expenses is tax deductible. According to one attorney, the Act does not address the deductibility of expenses funded with forgiven loan proceeds. Therefore, such expenses remain non-deductible for income tax purposes. So that becomes, kind of a murky issue. I guess the concern is that a write-off of expenses while leaving the loan untaxed might seem like double dipping. Now, overall, with the program, there is still nearly $130 billion in loan money still available. There is a short time frame, of course, to apply. People have up until June 30th to apply for that. But that's a significant amount of money when you think about it. As of June 3rd, the Small Business Administration has said that over 4.5 million actually small business owners have received a total of $511 billion in these loans. The average loan size was $113,000, with about 5,456 lenders approving these loans. So, good news that it's available. Good news that there's more flexibility for small businesses. Hopefully that will enable them to stay afloat. So we're going to take another quick break, and when we come back, we're talking about the restaurant industry and specifically the impact to them of the delivery apps. So more on that in just a moment.
Hear this out. There's a podcast network that covers just about everything that you've been searching. Hey! The Golden State Media Concepts Podcast Network is here. Nothing less than a podcast bliss with endless hours of podcast coverage. From news, sports, music, fashion, cooking, entertainment, fantasy, football, and so much more. So stop lurking around and go straight out to the Golden State Media Concepts Podcast Network. Guaranteed to fill that podcast itch. Whatever it may be. Visit us at www.gsmcpodcast.com. Follow us on Facebook and Twitter, and download us on iTunes, SoundCloud, and Google Play.
As most know, the restaurant industry has been hit particularly hard by the coronavirus and the lockdown. And whether or not currently restaurants are able to have dining room access and being able to serve largely depends on the rules in that state around social distancing and the requirements that they need to meet by either local authorities or state authorities. And in some places, of course, outdoor dining is permitted if the place can also abide by those requirements for social distancing. But during the pandemic, for those who still saw a possibility of staying open, to be able to provide takeout or delivery, the delivery apps were seen as their way to do it. It was that was going to be the magical fix for helping to keep their businesses afloat. However, over time, the businesses are seeing how much they're being gouged by the delivery apps, and perhaps gouged is too judgmental a word, because after all, the apps are businesses too, and this is their time to shine and make money. But I think for a lot of restaurant owners who are really living marginally, it's just really had a big impact, the cost of having these delivery apps, because basically they get paid by a percentage of the total order value. In one case, a story that I was reading in the New York Times talked about a restaurant that said that Grubhub charged more than 40% of the average order. And later, Grubhub had said that that's because this particular restaurant owner opted for an agreement that paid for additional advertising for his restaurant. Now, like this particular restaurant owners, others across the country have been outraged by this and feel they're kind of hurt. They're in a bad place with it because there's no negotiating these agreements. So there are restaurant owners in Chicago, Pittsburgh, Tampa, Boise, Albuquerque, and Richardson, Texas, who have been pretty vocal on social media to voice their objections over how the apps are kind of taking advantage of the situation. Add to that a lot of the restaurant owners are also fearing this idea of a merger between Uber and Grubhub. So if Uber Eats combines with Grubhub, I mean, they're pretty much going to be the only game in town. So that is, of course, a major issue as well. And in terms of the fees, it's not just the fees that owners are upset about. Some have said that some of these apps have taken to advertising. They're putting up advertising about their businesses and saying they no longer take orders, or putting kind of misinformation out there that the restaurant owners don't feel that they have the right to do that. So one particular restaurant complained that they had that their restaurant was represented online as not taking online orders, when in fact they were taking orders online and were open. So that can really hurt a business. I don't know, and this article doesn't indicate just how much that kind of practice is happening. But, nonetheless, when you see as much pain to the restaurant industries as you have, and the fact that this is nationwide, it does make you wonder just how many are really being affected. So spending at restaurants in recent weeks has dropped about 35% from a year earlier, while revenue for the delivery services has risen about 140%. And this is according to data from M-Science, which is an analytical transaction data firm. What is believed at the heart of the issue is that considering the costs that the restaurant has to pay, the typical restaurant has fixed costs such as labor, food, and rent, which takes up about 90% of the revenue coming in. And so that leaves very little money for anything else, any other types of services. So the delivery services, the apps, are taking between 20 and 30% overall from what each customer orders. So it's pretty substantial. I know that there was an earlier story that I had talked about several weeks back where businesses were putting on an additional charge, a corona charge, as it were, to help pay for some of the extra expenses. I'm not sure if any of that's being done to factor in the delivery fees. In that same story, it was said that some customers complained about the coronavirus surcharge, but most loyal customers didn't mind and sort of accepted that as part of the cost of doing business, and they appreciated the restaurants staying open to be able to do their takeout order. So hopefully some of this will be mitigated with the opening of dining rooms and people being able to come and pick up their food themselves. And, but again, the delivery apps, that's a business and they have every right to make their money. It's just that we do want to see restaurants survive if we can, especially if they're doing the work, they're buying the supplies, they're preparing the food, and being able to provide that to us. We'd like to see them be able to still continue to stay open during that time. So we're going to take another commercial break, and when we come back, we're going to talk about camps and the fact that in a lot of the areas in the country where camps are set up in more rural, serene areas, the local towns usually rely on those camps for their business and their income. And with many of the camps being affected by the coronavirus and not being open or delaying their open, naturally it has an impact. So more on that when we come back from this commercial.
Are you tired of the same old news? Are you sick of the seemingly endless political spin and negativity? The GSMC America Still Beautiful podcast is a weekly news podcast covering all the top positive and uplifting news stories. We cover stories that will inspire, uplift, and remind you of the good in the world. Tune into the Golden State Media Concepts America Still Beautiful podcast to get all the great and positive news stories of today. Download the GSMC America Still Beautiful podcast on iTunes, Stitcher, SoundCloud, Google Play, or anywhere you find podcasts. Just type GSMC in the search bar.
As if things aren't bad enough in trying to escape this ever-present idea of the coronavirus and it affecting every part of our lives. But you have travelers and parents who are scrambling to figure out alternative plans for this summer, particularly for those who send their kids away to camp, or maybe they go to a resort camp themselves. That's a big issue because there's a lot of camps that aren't opening at all, and then you have some that are delaying their opening till later in the summer. But either way, that still leaves, a gap in planning for if you were expecting to use a camp as a way to provide childcare while you worked during the earlier months of the summer. So it's a bit of an issue, but in this case, talking business news, the impact may not be readily acknowledged, but it's being felt in the small towns around these camps, whether they be in upstate New York or Maine or other parts of the Northeast. You have towns that, otherwise in the winter months are too cold. They don't get a lot of tourists or others coming there. They rely on the visitors and parents who come to these camps to bring their kids or go to the shows, or even to stock their kids up with things that they would need. These businesses have relied on that and making their money in the summertime to help them ride out the winter in the colder months. So, it's obviously another one of those domino effects with the, in this way, in the rural areas. Many sleepaway camps in New York, Massachusetts, Maine, and other states in the Northeast have canceled their seasons altogether. These camps typically welcome their first campers at the end of June and contribute more than $1 billion a year to the region's economy. So, that's pretty significant, especially when you're spreading that out to a small town. Many camps that do plan to open have signaled they will start later in the summer and keep children and staff on campgrounds and out of nearby towns and businesses. So for those that are opening, they still are not going to provide a lot of economic activity to these small towns. And by the way, some of the numbers that I'm citing in the story come from the Wall Street Journal in an article about this recently. There are small towns like Hancock, New York, has fewer than 1,000 residents, but more than half of them are older than 55, and they get most of their income from the summer activity related to the camps. The sleepaway camps, according to the American Camp Association, has accredited 39 within a 40-mile radius of the village of camps to bring people to the area each summer. And so just to give an idea of what that impact looks like, Mayor Carol Ann McGrath of Hancock, New York, said that we have very severe winters here. If businesses don't make the money in the summer, there's no way for them to make it up. And apparently within that radius of Hancock is a campground called French Woods. And the director there said that he's been buried in paperwork in processing $2 million worth of refunds after deciding in late May to cancel this year's programs. That's a whole other issue, the refund issue, and that, of course, goes across many different businesses and industries. The whole idea of, of companies or institutions having to pay back members' fees and registrations, and there's all different treatments of that. Some camps, by the way, are saying that they won't refund at all. Others are saying that they will apply it towards next year's camp or program. And there's been a lot of backlash on how some have handled it, where they didn't return the money right away. And of course, there's some that are still trying to figure it out and see how they can remain viable and open this summer. So they haven't made a decision yet about the refunds. French Woods had spent about $200,000 at Bisbee Lumber and Supply last year. That's in that town of Hancock that I mentioned. That accounts for the lumber and supply stores. That's about 1/10 of the business sales that they made in 2019. So again, just one particular customer and them not being open and needing the lumber will have a pretty big effect. And these decisions not to open don't come easily. For instance, another camp, the Kiev Wavis Education, a nonprofit foundation that has 2 camps in Maine, canceled camp for the first time in its nearly 100-year history. The wilderness trip camps usually accommodate about 1,200 kids each summer, and staff members often buy their lunch and snacks and other items in the nearby town. So once again, you consider 1,200 kids, the staff that it takes to take care of them, you can see what impact that might have on a local town. So hopefully next summer will be a different story for everybody, right? And people will be able to get out and spend their money in these small towns. We're going to take another break, and when we come back, our final story is a good news story about a business that's actually been able to do very well despite the pandemic.
The Golden State Media Concepts Travel Podcast, the show that gives you advice on everything travel. We explore places you've always wanted to go, as well as giving tips for traveling in those places. We'll give you advice on the best sites for travel tips, information, and discounts. Join us as we travel the world, explore cultures, and meet new people. The Golden State Media Concepts Travel Podcast has got you covered. Download the GSMC Travel Podcast on iTunes, Stitcher, SoundCloud, Google Play, or anywhere you find podcasts. Just type GSMC in the search bar.
For this last segment of the podcast, I thought it was appropriate to talk about purple mattresses. I mean, what can be more comforting than saying sweet dreams and going off to bed and being in a truly comfortable bed and being able to rest there? And I think that this story has kind of a peaceful feel to it, because basically it's a story about how a company who really laid the groundwork for their recent success over the past 4 years since they first introduced the product. DTC is the mattress brand that makes the purple mattress. And basically they credit their attention-grabbing content and advertising that it has done over the past 4 years as the reason why their sales have gone up incredibly during the pandemic. This article that I read in Adweek talks about how their sales have been up 170% in year over year during the month of April, and is likely still continuing. They have only been available, these mattresses, since 2016. However, because of the ads that they've placed, they have said that they've gotten over 1.8 billion views over the past 4 years. So obviously a lot of people are looking at their ads. They have, they do videos, and they do segments on YouTube, and apparently they're pretty creative, and some people have actually remarked that they're the only company with ads that you don't want to skip because the ads are that interesting and entertaining. So they've been using this approach all along, and their product, by the way, is made of a hyper-elastic polymer, and then has the distinctive purple color. And over the past several years, the direct-to-consumer brand experienced rapid growth that carried into the beginning of this year and well into the end of the first quarter. Revenue during the period increased 46% to about $120 million, up from nearly $84 million for the same period a year before. Profits also rolled in, with net income growing to $20 million compared with a net loss the year before of just under $1 million. So this is during a pandemic. To me, that's pretty extraordinary. After a temporary slowdown because of COVID-19, April's orders increased more than 170% year over year to about $54 million, again, during the pandemic. The company's growth isn't, however, from mattresses alone. They have some ancillary products such as pillows, sheets, and seat cushions. The majority, though, are in the mattresses. One of the things that's credited with their tremendous sales is a new ad campaign, which is a departure from its previous campaigns. Previously, the brand was one of the first to populate social media with infotainment spots. They would have clips of, they'd be about 4 minutes in length, and they relied on storytelling and humor to explain how Purple products work. In one ad, a Sasquatch family demonstrates how Purple mattress covers work. The content was characterized as juvenile but humorous, and successfully building awareness around the Purple brand at a time when video was underutilized. But the focus of the new ads was more. The focus of those ads was more on content than the product. Right now, however, in this new ad campaign, they've shifted the focus to try to get more focused on the feel and experience of the mattress as much as you can through a screen. And they, as I said, when you look at fast food chains and their ads, they're good at showing appetizing food. But when it comes to a mattress, it's hard to show how soft it is, how comfortable, how light a mattress is. And so the company really wanted to try to get what they call the same effect of bacon sizzling on a grill. The old adage about selling the sizzle with the bacon. Purple wanted to show off the support, lightness, breathability, and durability of its mattresses. In its ad, a montage shows blocks lowered onto the product. The mattress's material is stretched to its limit, and the product is floating through air. And then it all culminates in a final image of the mattress in a serene setting, promising restful sleep. So kind of using more imagery and the feel, the environment to promote it. And apparently they were successful. It's something that, again, has resulted in some great sales. So, and, overall we know that ad budgets have really declined. There hasn't been a lot of advertising with the lack of sports on TV and new TV content. It's the advertising has been really low lately. So apparently the advertising they are doing is effective and working for them. Well, that does it for this week's podcast, our business news podcast. I want to thank you for joining me today and for coming to the GSMC Podcast Network. I hope that you will go to wherever it is you subscribe to podcasts and subscribe to this one. And also, please check us out on our social media accounts on Twitter, Instagram, and Facebook. And please leave us comments if you like. Thanks again for joining me for the Business News Podcast, and I'll see you next time.
You've been listening to the GSMC Business News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at gsmcpodcast.com. Download our podcast on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you have enjoyed today's podcast.